Hey guys, welcome back to the Bitcoin Fortress podcast. This is episode 198. Today is January 11th, 2026. We are at block height 931,866. Moscow time 1101 and fees are 1, 2, and 2. Well, this week felt like a classic Bitcoin is fine, the narrative is noisy stretch. ETF flow whiplash, TradFi pushing deeper into Bitcoin products, policy chess moving forward in DC, and the usual reminder that custody plus security still matters. Let's jump into the news. We'll get started with markets, ETFs, and institutional pipes. First up, spot Bitcoin ETFs, a rough start to the year. Outflows and sentiment wobble. Multiple reports flagged meaningful net outflows early in 2026, and the risk on January vibe didn't immediately show up in Bitcoin ETF flows. So, don't over spiritualize ETF flows, but don't ignore them either. They are one of the cleanest real money sentiment gauges we've ever had for Bitcoin. Outflows don't mean Bitcoin is failing. They often mean macro uncertainty, portfolio rebalancing, traders rotating risk, or short-term liquidity needs. A simple mental model, ETFs amplify flows up and down because they make Bitcoin easy for allocators who don't self-custody, which there are a lot of them. Good time to remind everyone, though, that ETFs are a convenience wrapper. Bitcoin's core value is still sovereign bearer ownership. And that's, of course, what we like to preach here on the podcast. Next, Morgan Stanley files for a Bitcoin ETF and a Solana ETF. So TradFi keeps on leaning in. Reuters reported Morgan Stanley filed with the SEC to launch Bitcoin and Solana-linked ETFs. This is the continued migration from Bitcoin as fringe to Bitcoin as product shelf. The bigger implication here, of course, is banks evolving from passive exposure providers into active crypto advisors as the wrapper business, ETFs, custody, structured products grows. And of course, are they doing this because they believe in Bitcoin? Absolutely not. The banksters are doing it because they want to make money. And they've seen how successful BlackRock has been, and Fidelity, and all the other advisors. And Morgan Stanley's like, hey, I want a piece of that action. There was a time where you couldn't buy Bitcoin at all in Morgan Stanley, and then it was only for the wealthy customers, and now it's probably going to be everybody. And of course, they're going to want to sell you their fund, not someone else's fund, because, well, that's how you make money. Again, for Bitcoiners, this doesn't change Bitcoin. It just changes access. More access means more demand variability and more narrative noise. So, Wall Street can buy Bitcoin, but they can't rewrite its rules. Next up, some Bitcoin price action, pullback hesitation around the low 90s. CoinDesk noting that Bitcoin failed to hold a rally attempt and is drifting back towards $90,000. A choppy tape is normal when macro catalysts are pending and ETF flows are inconsistent. There's also, in my opinion, a big narrative battle going on right now about, is the 4-year cycle dead? Because everybody sold at the all-time high last year because they thought, oh, that's the peak and it's going to go down 80% or 90%. So let's just get out. And it hasn't really happened yet, but there's people that say, oh, but wait, Bitcoin's going to 10,000. hold on to your hats. And there's other people that are saying that broke the 4-year cycle, and so now it's just going to slowly climb for the next however many years. So there's a big narrative battle going on there about that. So meanwhile, and I guess in the middle of all that, you get chopped. But again, one thing to remember is that Bitcoin routinely stair steps and reprices violently to the upside sometimes and to the downside. And when it goes flat, it's boredom and people lose interest and people stop talking about it. And that's probably when you should be stacking until the next repricing. Again, it's a good framework to think about Bitcoin as there's two clocks. There's a trader clock and a saver clock. And of course, we are on the saver clock, so we don't really care whether Bitcoin's trading at an all-time high or a 52-week low. We are just trading that nasty fiat in for Bitcoin every single paycheck. Moving on to policy and regulation. Structure is the real fight going on right now. First up, the Senate Market Structure Bill hearings and markup momentum. CoinDesk reporting the Senate moving forward with a market structure vote soon, and the Bitcoin Policy Institute also flagged markup timing and negotiations. Market structure is where the United States decides who regulates what. What is a commodity versus a security? What's the sandbox for innovation? And of course, the institutions and the market in general is waiting for this, so it provides clarity so that they don't get in trouble or get sued by the SEC like happened in the last administration. For Bitcoiners, the key is preventing regulation by ambiguity that quietly strangles self-custody and open source development, which we want to protect at all costs. Again, watch the details, custody definitions, broker-dealer scope, DeFi language, and anything that tries to treat devs like intermediaries, which we've already seen a little bit of that with Samurai Wallet and others where they have been punished for writing code and have been called, operating without a money transmitter license or, supporting criminal activity or whatever. So code should be treated like free speech, and you should not be punished for writing code. It's how people use the code that matters. So, even good bills will be messy, and the win will be clarity that preserves permissionless Bitcoin. So we will sit back and watch, but it seems like the wheels are starting to turn on that now that everybody's back from their vacations. Next up, a macro catalyst on deck, CPI coming out January 13th, 2026. Kiplinger highlighted the next CPI report date and why markets care. Bitcoin, of course, trades like a high duration asset in the short run when rate expectations shift. So if CPI surprises hot, risk assets can wobble. If it's cooler, liquidity expectations ease. And of course, that's good for risk assets, which Bitcoin gets roped into that definition. Bitcoin is a long-term exit from monetary debasement, but it still gets marked to market by the macro traders. So again, sit back, relax, stack sats, stay humble through all of the noise. Next up, we will jump into corporate treasuries and the Bitcoin balance sheet era that keeps evolving. First up, strategy and the reality of Bitcoin treasury volatility. Reuters reported strategy disclosed large unrealized losses for Q4 of last year and commentary about reserves. Treasury companies are leveraged narratives on top of Bitcoin. They're important. Again, they're buyers, right? And hopefully not sellers, but they're not the base layer. So the bull case is disciplined accumulation and capital markets access. The risk, drawdowns, investor patience, and index inclusion mechanics. Speaking of that, next up, MSCI backs off excluding digital asset treasury companies from indexes for now. Financial Times reported MSCI didn't proceed with a proposed exclusion of DATCOs, and Barron's discussed the market reaction for strategy. This is a sneaky big deal. Index inclusion can drive forced buying and selling via passive funds. The meta story here is that institutions are still figuring out whether Bitcoin treasury firms are operating businesses or quasi ETFs. The takeaway here is even equity index mechanics are starting to orbit Bitcoin. That's adoption, messy, but real. And last, more corporate treasury creep beyond the usual suspects. A Morningstar PR item noted hyperscale data's Bitcoin treasury plus cash balance snapshot. The Bitcoin on the balance sheet playbook is spreading, sometimes prudently, sometimes as a marketing stunt. We need to filter, of course, and ask a few questions. Number one, do they have a time horizon? Number two, do they have an operational cash runway? And number three, do they have a clear custody policy? And finally, number four, no forced selling risk. So before you invest in those guys, if that's what you choose to do, although I'd rather just buy Bitcoin, you got to think about those things. Next up, we move on to mining difficulty, mining and network fundamentals. Boring equals bullish. Bitcoin difficulty adjustment and early 2026 shift and what it signals. Coverage noted the first 2026 difficulty adjustment and referenced CoinWars estimates for the next adjustment window. Difficulty is the heartbeat of security for Bitcoin. Price can chop, but hash plus difficulty show the underlying competition to secure the chain. If blocks come in faster than 10 minutes, difficulty rises. If slower, it falls. Quick primer on the difficulty adjustment. Practical implication is miner profitability pressure can drive consolidation of miners and perhaps selling of Bitcoin, which is miners are the natural seller of Bitcoin since that's what they produce and what they have to sell in order to pay their bills. But the network self-corrects relentlessly, and the trend on hash rate, of course, as we know, has been very strong up and to the right with very few pullbacks other than when China came offline, and then everybody just moved somewhere else because, well, of incentives. Next up, we will talk a little bit about security, custody, and the system. First up, a $27 million multi-sig compromise. Multi-sig, of course, isn't magic. Yahoo and The Block reported on a multi-sig wallet compromise and laundering activity. Multi-sig reduces certain risks, but implementation, key management, and operational security matter more than the buzzword. Multi-sig best practices versus multi-sig somewhere in a web app with sloppy OPSEC is what you need to be thinking about. So, public service announcement, hardware keys. If you have a 2 of 3, make sure that one of your keys is somewhere else, not at your house. If you have both of them at your house, then you don't really have good OPSEC. And don't leave one at your house and then also leave the backup paper or steel key in your house, because they could use that to restore the key and then take the other key and then you're SOL. So, and then of course, recovery drills and then minimizing attack surface, all very important things to remember. So, multi-sig is great if you implement it correctly. If you don't implement it correctly, if both of your keys are of your two of three, or even if you have three of five and three of your keys are all maintained online in, I don't know, your phone, in a folder, in a file somewhere that could be easily taken, then you have not really accomplished your goal. Next up, Samurai Wallet forfeited Bitcoin controversy, sale versus strategic reserve narrative. So Yahoo reported that the US Marshals have denied selling forfeited Samurai Wallet Bitcoin. Bitcoin Magazine framed the dispute around whether forfeited Bitcoin should have been handled differently. Financial surveillance versus privacy tools is what we're talking about here, and how the state handles seized Bitcoin. Even the rumor of government Bitcoin moving can become a market narrative because state custody is opaque by default. In fact, there was a rumor also that in conjunction with the taking of Maduro in Venezuela, that the U.S. also had, not only did it have its eyes on Venezuela's oil and natural resources, but also its Bitcoin, which supposedly they have something like 600,000 Bitcoin that they were accumulating from sale of oil or whatever they were doing. And so who knows what happened to that? That may end up in the US's coffers. We'll have to wait and see. I'm sure somebody online will figure it out by scraping through the data of the blockchain to see where those wallets are and whether or not they move. But again, more rumors about that. So, if you care about these outcomes, we just need to point back to self custody and privacy hygiene. All of that is very, very important, and we want to protect that Bitcoin. Moving on, product and protocol, keep it grounded. Bitcoin Core releases, keep your nodes current. Bitcoin Core maintains the live releases page. You can use this as recurring hygiene for your own implementation. But personally, I launched my Bitcoin Core quite a while ago, and I have just chosen not to upgrade to the latest version of the software just because. And then I didn't get worried about the whole Bitcoin Core 30, opcode, this and that. I just like mine. My code, my instance runs. It's always backward compatible. I'm not going to worry about it. So you can do the same thing if you want. Of course, remember, nodes aren't mandatory for owning Bitcoin, but they are foundational for verification culture. Using your own node to verify your coins is wonderful, good, and it also supports the network. If you run a node, though, pay attention to official release notes and upgrade thoughtfully, as I just mentioned. Some Bitcoin podcast themes from the past week. First theme, macro is the weather, Bitcoin is the climate. What Bitcoin did, ran macro structure heavy conversations. Episode listings show 2026 macro outlook among current episodes. Rate expectations can push Bitcoin around weekly, but the long-term driver is monetary credibility and adoption. The next theme, protocol development and quantum chatter, plus cultural split, institutions versus cypherpunks, And of course, we also have the ongoing battle between Bitcoin Core and Bitcoin Knots. Don't let Quantum FUD become clickbait. Use it to teach yourself about what actually upgrades in Bitcoin and why decentralization is slow on purpose. And if you want to learn a bit more about Quantum FUD, check out my blog. I wrote a few articles on that to try to cut through all of the drama and get to what's really going on there. Education is super important, and it's important not to panic when you just see something posted online or whatever. Deflation, productivity, and why the system prefers inflation is the third theme. Coin Stories featured Jeff Booth discussing why prices rise while quality gets worse, deflation versus inflation dynamics. I actually listened to well, I'm halfway through listening to that one myself. Always wonderful to listen to Jeff Booth. He's just an amazing guy and has an incredible worldview as it relates to Bitcoin and operating within the system that we have and trying to solve problems from the same system, which he talks about all the time. I, of course, have been writing about this or creating video posts on it in my blog. There's a new series that I just launched called Bitcoin versus the System. Inflation just isn't economics, it's governance by stealth. And Jeff talks about that a lot and about control systems and even gets into politics and how capitalism, we never really understood what capitalism is because we've never seen a true free market ever. And all governance systems, whether authoritarian, they're authoritarian capitalist or authoritarian socialist, they're all control systems. And he's just not a big fan of the politicians either, which I also like. And the fourth theme, neutral reserve assets in a messy geopolitical world. TFTC featured geopolitics framing, the Monroe Doctrine, multipolar world that maps to Bitcoin as neutral money narrative. When trust erodes, neutral settlement assets gain relevance. Bitcoin is the digital bearer version of that idea. Next up, wanted to mention this week's featured Substack post. The post is entitled Bitcoin Infinite Banking When Nelson Nash Meets Sound Money. This was actually a follow-on to another post that I had on the same subject that was prompted by some comments I received on a prior post. And so it was just kind of a fun rabbit hole to dig down into. Started out with the concept of the Bitcoin family bank, then kind of started talking about Bitcoin denominated life insurance policies because they're actually out there now versus fiat denominated life insurance policies, and then wrapping that into the whole concept of the Nelson Nash infinite banking. So, the core takeaway, of course, is traditional infinite banking can build a personal financing system, but it's still usually anchored to an inflating unit of account. My thesis is that Bitcoin completes the equation by fixing the money itself. So infinite banking, if you don't know what it is, it's a personal liquidity system using whole life insurance policy cash value as a financing base. And so infinite banking plus fiat, and here it's fiat's decay, but infinite banking plus Bitcoin savings changes the long-term math. Don't need any numbers in this example. We'll just say that instead of selling Bitcoin at the wrong time, you finance life events without sacrificing long-term upside. But structure matters. Policy design, counterparty risk, and not getting wrecked by complexity, of course, are very important. And a lot of homework is required in this area if you plan on doing something with that. But anyway, check it out, link in the show notes. And if you want to go deeper, check out my 3 Bitcoin Fortress books. They're designed to be practical, straightforward, and focused on building real-world conviction and resilience. And again, links in the show notes to that, as well as all the articles that we covered here today, if you want to dig deeper. And so that's it for this week. If you found value here, share the show with a friend who's trying to make some sense out of this crazy world that we live in with a crazy start to 2026. And until then, until next time, stay humble, stack sats, and build your fortress. We'll talk to y'all next week. Bye-bye.